Hi, welcome to the Market Alert for Friday, the 3rd of April 2020. So, we've got Trump sparking a rally in black gold, i.e. oil, as bullion demand soars to 3-year highs. No surprise on the bullion demand. If you look at the end of the Financial Road Part 2 and 3, I talk about it in there. In times of uncertainty, fear, this is where the smart money goes. It goes into the gold market to hedge against the prospect of hyperinflation. But before that, the deflation phase that we will see, and depression, of course. So let's start off by looking at yesterday's jobless figures because, as we know, these were far higher than predicted. We were forecast at 3.6. It came out at 6.648. A massive jump in these figures. And if I can find the right chart, there you go. So now we're sitting at the 6.648. I mean, this is just insane. Have a look at this. And there are predictions of unemployment rates going as high as 47% in the US, as well as we go forward with the coronavirus shutdown. Massive spike here in the unemployment figures. And again, obviously, the Fed not knowing what to do, or the Treasury, when they predict 3.6 and it comes out at 6.6. However, the market managed to shrug this off, and I'll take you through this chart here. As you'll see, I'll just drag it over to the left. We'll start off with the news coming out. Prices dropping over 600 points, which you'd expect. And to be honest with you, you'd expect it to continue further, given that the figure was double what was forecast. However, that's not the case. We get the usual pattern that we've had for the last 10 years. Prices rally up to the 20-bar moving average. They retrace to the 62 and 76% retracement. Also, the low of the previous day. So all nice and support areas here. Market moves higher, manages to break through the 20-bar moving average, the previous day's close price, and then stops at the 50-bar moving average before managing to break through this and the 200 MA there. Prices then continue higher on two big bars. These bars alone are 150 points each, and then the market reverses 150 points to stop the move. Prices then retrace back to the 200 MA and also the DP level, which you can see there with the purple horizontal line. Prices then oscillate around the 20-bar moving average, creating a bit of resistance initially in these two bars. As prices come down to the 200 MA, try to go back above the 20, they fail there, but then manage to do so. And guess where they stop? 76% retracement from this high to this low. Prices then move back to the 20-bar moving average, manage to get back above, but then stop at 76% from here to here, and then move lower. I'll just drag the chart over and manage to sit at 76% measured from here to here. And then prices put in some buying, which you can see there with the green bars, and then pull back and then continue higher, whether it's the plunge protection team or whatever, but the market manages to move back to the high of the day before closing. And then overnight prices have managed to trade back to the DP level, which you can see there, and closing below the 200 MA. Tried to come back through here, but managed to move back and then failed and has moved lower, and is now trying to come back to the DP and the 200 MA there. So today's a big day. We've got the non-farm payrolls out today. It'll be interesting considering that they're only forecasting minus 100,000, given that they've got it terribly wrong in both weeks where the initial jobless claims have both been way off mark. It'll be interesting to see this at 1:30. I'm no doubt that we could have a repeat of what we see here for yesterday's price action. To be honest, if the figures are worse than predicted, down, up, down, and then we do the usual stuff through the afternoon and then finish on a high. That said, when I look at the daily chart, there is a prospect that we could see lower prices when you look at the bigger picture. the market's currently struggling with the 5-bar MA and the 20-bar MA, the 5 being the sort of pink purple and magenta, and the green one for the 20-bar MA. We need to take out this low and also the 38% fib retracement drawn from here to here in order for prices to move lower. But that's down to the non-farm payroll figures at 1:30 and whether they want to come in and support prices and move them back to the upside. Who knows? Who knows? In the weekly chart, we can see we're still sideways and still currently below 21,597 there. And in the implied volatility, we'll just move along here. We can see that we've got a drop in this to 53.76, down from 65 for yesterday, as they managed to move the markets higher following the release of the jobless claims figures. Now let's have a look at something else, the Fed's balance sheet. So let's just come over here and let's just move to this headline. Fed's balance sheet hits 6 trillion or 1.6 trillion in 3 weeks. Just think about that. 1.6 trillion in 3 weeks. And this doesn't include Pelosi's deal either. That's a separate 2.2 trillion. So let's have a look down here. And this is the interesting bit here. It says the Fed's balance sheet has increased by a ridiculous 1.6 trillion, the same amount as all of QE3 did over 15 months, and equivalent to an insane 7.5% of GDP. During the last 10 years, GDP for the US has averaged between 1 and 2%. So again, think about this as the printing money. It shows you just how much money is being printed when it's actually 3 times the amount of the best GDP figure for the last 10 years. These two charts are fascinating as well because Bloomberg has research has created these two projections, and I wouldn't disagree with these at all. In yellow, you can see that the projection is by year end that we will have 9 trillion on the balance sheet printed in just X number of months. It's staggering, and will be in the region of 40% of GDP as well, whereas the current value at 6 trillion or just under 6 trillion is 15% of GDP. So again, you can see that going forward, it's not going to work. Simple as that. The Fed's buying everything they can. They're changing the rules. They're buying corporations. They're buying, you name it, they're buying it. Anything to try and stave off a global depression. But the damage is already done. We can see that from the balance sheet. And we can also see that from the unemployment figures as well. And it's no doubt going to get worse once more today as well. Okay, that will do it for this one. Keep an eye on the non-farm payroll figures at 1:30 and let's see what the market's reaction is. As ever, have a great weekend and also thanks for watching. See you in the next one.